Hello and welcome back to Explain the Charts. Today is Tuesday, October 14th, 2025, and we have a very volatile market environment to dissect for the Nasdaq 100, ticker QQQ. Let's start with the current events, as they are heavily influencing the price action. Overnight, futures have turned negative, pointing to a lower open today, primarily due to renewed fears over U.S.-China trade tensions after Beijing announced retaliatory measures. This comes directly after a huge rally yesterday where the Nasdaq gained over 2% when President Trump seemed to temper his tariff talk. This kind of whipsaw action is a direct result of conflicting geopolitical headlines, creating a trader's nightmare and opportunity. Adding to the uncertainty, we have major banks like J.P. Morgan and Goldman Sachs reporting earnings, a speech from Federal Reserve Chair Jerome Powell, and an ongoing government shutdown. This all follows the massive 3.6% drop we saw last Friday, October 10th, which was triggered by Trump threatening 100% tariffs on China. So the market is being pulled in multiple directions by powerful macro forces. Now, let's look at how this is playing out on the QQQ daily chart. From a long-term perspective, the trend has been strongly bullish for well over a year, culminating in an all-time high near 613 just last week. However, look at this massive red candle on October 10th. That's the market's reaction to the tariff threat, a bearish engulfing candle that wiped out a week's worth of gains in a single day. Yesterday's green candle shows the sharp bounce back on tempered news, but it's important to note that we failed to reclaim even half of Friday's losses, closing around 602. The fact that futures are pointing lower today suggests that yesterday's rally may have been a short-lived relief bounce. The key overhead resistance is now firmly established at that all-time high of 613. Any sustainable move higher needs to break and hold above that level. On the downside, the most critical support level to watch is the low from that October 10th candle, right around 589. A daily close below 589 would be a very bearish technical signal. If that level fails, the next major support zone comes into play around the 575 to 580 area, which was a consolidation zone back in late August and early September. If we zoom in on the action since the beginning of September, this recent volatility becomes even more stark. Notice the volume on the October 10th sell-off. It's the highest we've seen in several months, indicating strong conviction from sellers. Now compare that to the volume on yesterday's rally, which was significantly lower. This divergence, where a down move has higher volume than the subsequent up move, often suggests that the path of least resistance might be to the downside. It implies that the bounce lacked broad participation and conviction. Right now, we're witnessing a clear battle between the long-term bullish trend and the overwhelming short-term bearish macro news. The chart is suggesting a potential temporary top has been formed, and the market is deciding whether this is a small pullback or the start of a more significant correction. Let's switch to the 1-hour chart to analyze the shorter-term picture for the past week. Here, you can clearly see the waterfall decline on Friday, with consecutive large red candles showing relentless selling pressure. Then, we see the gap up on Monday morning, followed by a steady grind higher throughout the day. However, the price action began to stall outright around the 603 level late in the day yesterday. That 603 level will now act as a key intraday resistance point. For today's session, the primary support level to watch is yesterday's low, right around 597. A break below 597 on the hourly chart would be the first confirmation for bears that the downtrend is resuming, immediately putting the major daily support of 589 back in focus. On the flip side, if bulls can push the price back above the 603 resistance, their next target would be to start closing the large gap from Friday, with the next resistance area being around 610. Finally, let's drill down to the 15-minute chart for a day trader's perspective. We can see the massive volume spikes during the capitulation sell-off on Friday afternoon, which often marks a key price zone. Yesterday's price action formed a nice, clean intraday uptrend with a series of higher highs and higher lows. However, the negative pre-market sentiment suggests this uptrend structure is likely to break right at the market open. The 600 level is a major psychological battleground for today. Watch for how the price interacts with this whole number in the opening minutes. If we see a weak open that breaks below yesterday's low of 597.23, look for bearish momentum to pick up speed. Alternatively, if buyers show up to defend the 597 level and manage to reclaim 600 with conviction, it could signal a failed breakdown and a potential squeeze back towards the 602 to 603 resistance zone. To summarize everything, let's recap the important levels and potential outcomes. Your key upside resistance levels are 603, then the gap fill area around 610, and finally the all-time high at 613. Your key downside support levels are yesterday's low at 597, the critical line in the sand at 589, and then the larger support zone at 575. Now for our unbiased predictions. The bullish scenario is that the China news is just posturing and Powell's speech is perceived as dovish, leading to a strong defense of the 597 support. A firm reclaim of 603 would strengthen this case, making a move back towards 613 possible. Given the current negative headlines, I'd assign this a 40% probability for the short term. The bearish scenario is that trade fears continue to dominate or bank earnings disappoint, causing a decisive break of 597. If the critical 589 support level is breached on high volume, it would likely confirm a short-term trend reversal, opening the door for a deeper correction towards 575. With the current news cycle, I believe this has a 60% probability in the immediate term. The things to watch today are the market's reaction to the morning's earnings reports and any and all headlines from Fed Chair Powell's speech. Volume will be your confirmation signal. High volume on a break of support validates the bearish case, while low volume could signal a head fake. Thank you for joining this market analysis here on Explain the Charts. As a final reminder, this video is for informational and educational purposes only. It is not financial advice, and trading stocks involves a significant amount of risk. Please do your own extensive research and consult with a certified financial advisor before making any investment decisions. Trade smart, stay safe, and we'll see you in the next video.